Dear students, this is lesson number 6 for the students of economics for class 12. Let's continue with unit 6, which is money and banking, and this is the continuation of lesson 5. Now, in this lesson, we will do the fourth function of the Central Bank of India or the Reserve Bank of India, which is credit control methods. Now, these are the various credit control methods of the RBI. You have the quantitative methods and the qualitative methods. We will be discussing all the quantitative methods in detail, but only variation in margin requirement is in your syllabus for the qualitative methods. The other methods under this will be left out. So let's see the first method, which is bank rate. The bank rate is the interest rate at which the commercial banks can borrow from the central banks to meet their long-term needs. Now, this rate is fixed by the central bank, and the banks may increase or decrease these bank rates. Now, raising of bank rate will force the commercial banks to raise the lending rates, which makes borrowings costly. Now, what is lending rate? Lending rate is the rate at which commercial banks give loans to the general public. And interest rate is the rate at which the central bank gives loan to the commercial banks. Okay, so that's the difference between both the rates. Okay, so raising of bank rate will force the commercial banks to raise their lending rate, which makes borrowings costly. This discourages the borrowers and leads to a decline in the loans, further leading to a fall in the demand for goods and services. This helps in checking inflation. Now, if we lower the bank rate, it will have the opposite effect. It will result in lower lending rates, thus encouraging loans. It will lead to increase in demand for goods and services and thus check deflation. Now, open market operations. It refers to the buying and selling of government securities by the central bank. Now, let's see what happens when the central bank buys the securities. What happens is that excess money supply flows from the central bank to the commercial banks of the respective sellers. This increase in the money supply with the commercial banks now raises the credit creation capacity of the commercial banks. Thus, it increases the loaning activities, which increases the demand for goods and services. This helps in checking deflationary tendencies. On the other hand, when the central bank sells the securities, the excess money supply flows from the buyer's commercial bank accounts to the central bank. The commercial banks now have a lower credit creation capacity. This discourages loaning activities as the commercial banks have less money supply. The demand for goods and services now reduces. This helps in checking inflationary tendencies. Okay, so repo rate. Repo rate is the interest rate at which the commercial banks can borrow from the central banks to meet their short-term needs. Now, raising the repo rate makes borrowings by the commercial banks costly, forcing the commercial banks to increase their lending rate, thus discouraging loans and bringing down the demand for goods and services and checking inflation. And when the repo rate is decreased, the reverse happens. Reverse repo rate is the interest rate at which the commercial banks can deposit their excess funds with the central bank. Now, raising reverse repo rate reduces liquidity with the commercial banks and has an adverse effect on the credit creation, thus checking inflation. And decreasing reserve repo rate has the opposite effect. It helps in checking deflation. Cash reserve ratio. Now, this refers to the percentage of deposits that the commercial banks should keep with the central bank. Now, increase in cash reserve ratio will reduce the liquidity of commercial banks, thus limiting their credit creation capacity. And a decrease in CRR will increase the liquidity and thus increase their credit creation capacity. Now, cash reserve ratio, as you know, it is the amount of deposits that they should keep with the central bank. Statutory liquidity ratio. Now, this is the amount of deposits that they should keep in the form of liquid assets with the bank itself. Now, this again has the same effect as CRR. Increasing SLR will reduce credit, and decreasing SLR will increase credit. Now, margin requirement, as I told you, is the only qualitative measure that we have to study. Now, what does it refer to? It refers to the discount fixed by the central bank on the assets mortgaged as security by the borrowers to the commercial bank. For example, if the margin is fixed as 20% by the central bank and a borrower pledges a building worth rupees 50 lakhs, he will get a maximum amount of only rupees 40 lakhs as loan and not the entire 50 lakhs which he had claimed for. So it is clear, higher the margin amount, lower is the amount that can be borrowed from the commercial banks. Now, why is margin requirement necessary? It is required because if the bank gives a loan equal to the value of the full security, then the bank will face a loss in case of fall in the price of the security. And the last function is custodian of foreign exchange reserves. Now, this function enables a central bank to exercise control on foreign exchange. It helps the banks in stabilizing the external value of currency and also in pursuing a coordinated policy towards balance of payment situation. Okay, now it's time for assignment. Quickly, I'll read out all the questions. Now, this is assignment number 4. The first question: define a bank. Question number 2: how are banks different from other financial institutions? Question number 3: what is legal reserve ratio? Explain its two types. The next question: explain the credit creation process of banks with the help of a numerical example. And you should take LRR as 25%. And the last question: what is money multiplier? How is its value determined? Now, to do these questions, you must again look and hear lesson number 5 so that you can answer this assignment. Assignment on lesson 5. Define a central bank. Question number 2. Explain the bank of issue function of the central bank. Third question: how is a central bank a government's banker, agent, and advisor? Fourth question: explain the function banker's bank and supervisor. And the last question: what is the difference between monetary policy and fiscal policy? Assignment number 6. This is based on lesson 6. Now, how does bank rate influence credit creation capacity? Question number 2. How can SLR and CRR be used by the central bank to check inflation? Third question. Explain the role of repo rate and reverse repo rate to control money supply. Fourth question. What are open market operations? How can the central bank use it to influence credit creation? Next question. Explain how margin requirement is an important tool in the hands of central bank to control credit. And the last question, why is central bank a custodian of foreign exchange reserves? Now for all these three assignments, you should look at the previous lessons and refer to Sandeep Garg or S.K. Agarwala to complete these assignments. If you don't have the register, no worries, please do it in sheets to be attached to your new register later on. So with this, we come to the end of lesson number 6. Please do the assignments sincerely. Thank you.